Thank you. So my name's Anthony Hene. Excuse me. I work at GMO, which is an institutional investment manager. So we look after equity and multi-asset portfolios for some large institutions who measure our performance against benchmarks or in various ways. Now, when Michael Mainelli asked me to, if I was interested in talking at this conference, we were in the process of removing the last vestiges from of benchmarks from the way that we construct portfolios for our clients. So it seemed like a nice subject to sink one's teeth into. So specifically, I'm going to be talking about long-term performance measurement with an emphasis on investment management. Okay, so let's start out by imagining what a truly long-term investment contract might look like in a rather blacked out kind of manner. What we've got on the screen here is kind of the fantasy of most investment managers, that a client comes up to them and offers them this mandate that they'll fund today, and then they are going to guarantee that you keep the money until 2042. And let's just pretend for a moment that the blacked out stuff on the page here provides all of the cover for both parties to go away and forget about the mandate for the next 28 years. So there's an explicit disclaimer. Don't worry about your fiduciary responsibility to manage. Don't worry about your regulatory responsibilities. Don't worry about the perverse incentives that this might set up for the investment manager. Don't worry about institutional stability of the investment manager or our own institutional stability as an investor. Let's just wait and see what happens at the end. Now, if we put this plan into action, of course, performance measurement in that context becomes an absolutely trivial exercise. We've got 28 years of data. It will be absolutely clear at the end of the 28 years whether the investment manager has done a good job. You can tell that in the returns to the portfolio. Did it beat inflation? Did it beat passive alternatives? You wouldn't even need to worry about risk at that point, because to the extent that the manager had taken on good risks that were worth taking on, they'd be baked into the numbers at the end, and if the risks weren't paid, the numbers at the end would be lousy. But of course, there's something rather unsatisfactory about that as a way of doing business. So let's imagine, nevertheless, let's take another cut at this. Same contract, but this time we're going to keep, as an investor, we're going to keep one eye open and look at how things develop. So let's imagine the money came in today, this afternoon, thank you very much. But in September, the Russian tanks roll into the Baltic states, and the Chinese decide that this is perhaps an opportune moment to take over the Korean peninsula, and markets take a massive fright. So markets are down 70%, and suddenly this long-term investment contract, 28 years is looking like an incredibly long time. You can well imagine the original plan kind of looking a little bit shaky at this point. And the reason I frame the problem to start off with like this is that although we think about the long term, we live in the short terms. And in reality, we can't help but look at short-term performance. And so the purpose of the talk really is to try to first think about conventionally how performance is assessed in the short term. But then I'm going to move on to propose a couple of alternative ways of thinking about short-term performance, but with very much a long-term mindset. Okay, so let's start out with the standard stuff first. So I guess the standard ethos when thinking about performance and investment would be to try to separate the analysis of the outcomes from an analysis of the decision-making process. So the classic layout for thinking about this comes from a book called Winning Decisions by Russo and Shoemaker from 2002. So they just come up with a simple grid. And let's populate this for a moment with some investment examples. So let's imagine that it's 1999 and you're about to invest a big pot of money. You've done your homework. You've realized that this contrarian strategy, whose performance is shown here, has historically done extremely well. So you put your money in and bang, that works out very well for you. So we'll chalk that down to the good outcome, good process, deserved success part of the grid. We'll have a look at another one now. Let's say you'd really done your homework valuing European equities. It's coming to the end of 2011. You put your money in on low valuations. That didn't work out quite so well for you. But you've done your homework, your decision process was good. We'll put that in the bad breaks section, and it probably was just a bad break because the European equities came back quite nicely from there. Moving on across the grid a little bit more quickly. So you notice that this bunch of stocks had done extremely well, exponentially improving, and had a bit of a pause, so you put your money in there. And it came good. Well, we're going to call that dumb luck because this was investing in companies with operating income in New Zealand and Portugal. In other words, a random strategy, basically. And just to complete the circle, similarly, this group, you got your head handed back to you on a plate because this is Spanish companies whose names begin with the letter M. So we'll call that poor performance there poetic justice. So everybody knows that if you're trying to analyze investment performance, you need to separate the decision-making process from the outcomes. And there's a whole section of the investment management industry that's designed around trying to do just that. There's lots of consultants and multi-asset managers trying to make those sorts of assessments. But it's extremely difficult. So the most common framework, perhaps, is the 3 Ps. So investment managers are assessed by their philosophy, their process, and their people, which sounds great, sounds sensible, but it's a really difficult thing to do from the outside. I had an exceptionally tedious flight about 10 years ago where I sat down and read through the investment philosophies and investment processes of 50 of the largest institutional investment managers. And what I was absolutely gobsmacked by was the fact that the terms were just coming up again and again and again. Everybody really describes their philosophy and process in similar kinds of ways. But the good news is that since the advent of the fantastic Wordle website, which you can find at wordle.com, you can take thousands and thousands of words of documentation, shove it into the website, and it'll throw up a nice picture for you, illustrating what the important phrases were and words that came from the documents. So the pain of the reading all the manager descriptions doesn't have to be yours. Instead, you can just go to the website. Now, it's, I think, a well-documented fact that 80% of investment writing is absolutely vacuous and meaningless. So it's no surprise that 80% of the terms that come up as most common in these investment write-ups don't convey much meaning. So it seemed to me that about 30 terms described almost everything that investment managers do. And in fact, they go into 6 buckets. I won't go through the buckets, but the point is, it's extremely difficult as an outsider to assess exactly what's going on behind the closed doors at an investment management house. It's a tough exercise, and assessing people is extremely hard too. Just very briefly, I won't go into this one in any depth, but there's not much systematic you can do on people. You can measure a few things. There was a nice study by Greenwood and Nagel that looked at the average ages of people holding technology stocks in 1999, and unsurprisingly, the younger, inexperienced managers were the ones who made the dumb decisions at that point. But I really feel for those who are trying to assess managers from the outside in this kind of way. It is just so difficult to separate the decisions from the analysis of the decision-making process from the outcomes that are far more easily observed. I think that there's a nice example from outside of fund management and going back a few thousand years. So Alexander the Great was 22 years old when he went out to attack the Persians and the first of his major skirmishes with the Persians. And he and his group of brave Macedonians landed up by the river Granicus. So the Macedonians are on one side of the river, the Persians are on the other side of the river, and Alexander's only 22. His advisors get together to start discussing tactics, but he basically says, sod this. He puts on his hat, which makes him clearly identifiable. It's got white feathers going along the top, and just steams into the Persians on the other side of the river, starts slashing away at them. And there's this Persian satrap who gets out his axe and manages to land a blow on Alexander's head. He's about to deliver the coup de grace when Alexander's pal Cletus steps in and spears the Persian. The Persian will's broken. 20,000 of the Persians are killed for 300 Macedonians. And history, of course, remembers Alexander the Great rather than Alexander the impetuous young meathead who steamed in and nearly got himself killed. Naturally, we anchor on outcomes. You may have seen the slide that I skipped past here. But the punchline's rather given away here. This is the record for Madoff's funds. And you know, it looks nice, doesn't it? It's not too difficult to understand why people were influenced by outcomes there rather than by thinking about the things that they should have really been thinking about. Okay, so if the outcomes are so hard to resist, then what I'd like to do to propose as a counter to the prevalent way of thinking about this is a few alternative ways of thinking of outcomes. So in other words, trying to put a long-term spin on assessing short-term events. So I'm going to make three proposals. The first one, and this is possibly the only time in my life I'm ever going to say this, but I would encourage you here to try to think like the tax man. So think about, one way that you can think about returns is instead of the conventional look at the market-priced return on my portfolio, instead say, I'm only going to think about returns that come in the way the tax man would recognize them. In other words, income and then crystallized gains or losses. So let's just have a look at an example of how that might work out. So first I'm going to show you conventional returns to a portfolio of global equities that we look after for the calendar 2012. So at the start of 2012, markets were optimistic. They rose about 10%. But then in March, Greece defaulted and markets took a big swing downwards. If you're sitting on the other side of that as an investor, you're perhaps getting worried at this point. Markets rebound a little bit. Draghi comes in, offers to do whatever it takes, and believe me, it will be enough. And the portfolio whizzes off and does extremely nicely. But there was a really worrying moment in the middle of the year. So if we instead look at crystallized returns, and this is just supposed to be an attention-directing device, it forces you to think about the returns that it forces you to distinguish between a squall of volatility and a permanent impairment to the portfolio. Because at the time, at the end of May 2012, you're worried that you've been permanently impaired. But the crystallized return for that year did virtually nothing, because in this case, the portfolio had relatively little turnover. It sold practically none of its European holdings that were hammered very hard in March and April of that year, and came across the year fine. So there are ways that you can think about performance and measuring outcomes that aren't necessarily driven by short-term considerations. Now, this measure proposed here is obviously flawed in some sense. So if your manager did no turnover at all, obviously that you'd just see the dividend yield there. That wouldn't be that informative. If your manager had a great stop-loss program, you'd just see the pain of the stop-loss and you wouldn't necessarily see the gain of the rebound. It's a gameable kind of measure, if you like. But it's a way of framing the short-term with long-term kind of lenses. So my second proposal comes from Warren Buffett. So he wrote in the 1996 owner's manual that he and his partner measures their success by the long-term progress of the companies that they've invested in rather than the month-to-month movement of the stocks, and that short-term price changes are meaningless except to the extent they offer an opportunity to buy stock at a better price. And he goes on to say that they think about the long-term progress of the companies that they've invested in by the accrual of intrinsic value or the increase of intrinsic value of their investments. And acknowledging that intrinsic value or true worth isn't something that you can precisely measure. Buffett proposes using book value as a proxy for that intrinsic value. And so this is quite a neat idea. It's another way of directing the attention away from the short-term volatility of the stock market and onto some of the things that really matter within the underlying portfolio. So here we show the S&P 500 in blue, which is volatile and moving around all over the place, and the book per share index underlying that is much more stable. So in green for long periods, it doesn't show much volatility and rarely deviates too far from trend. Now, I think this is nice in theory because it directs the attention to the fundamental wealth-generating process underneath the portfolio rather than short-term market volatility. But of course, there are flaws in this approach too. So if, for example, you were a value manager who looked to make profits by investing in companies whose book per share was declining, your strategy is in essence to convert shrinking book values into capital gains, and that would not get recognized in this kind of measure. Or similarly, if you were one of those enthusiastic youthful investors in 1999 buying tech stocks, you could show that your portfolio had fantastic book growth, but at the same time ended up with rapidly shrinking capital. So this isn't perfect, but I think it gets at something fairly fundamental. That, incidentally, there is a consultant who has a version of portfolio performance measurement that's something like this, and he's fixed some of those problems, but his non-disclosure agreements are so fearsome, I'm not even going to mention his name. Incidentally, Warren Buffett looks quite good on the measure that he proposes to look at his portfolio, but perhaps one shouldn't be too catty because he looks pretty good on every measure that you use to measure his portfolio. Okay, so the third proposal, and this probably only counts as half the proposal. I've talked about the flaws that are problematic for the crystallized returns and for the book index return measurement. And in certain cases, you'd expect them to misfire. But I guess it should be possible in theory for most managers with well-defined investment philosophies and investment processes to come up with some form of tailored attribution that can be put in front of their clients to explain what the underlying processes are that they're trying to exploit and to provide a reasonable long-term framed view of the short term. So at GMO, for example, the main input into our investment approach is what we call our 7-year asset class return forecasts. I've shown the values on the page here. They're basically extraordinarily depressing at the moment for equity markets that are quite fully priced and not much better for, or no better for the fixed income markets because valuations have been pushed up for all asset classes everywhere. But because there is a very clear methodology that sits behind these forecasts, and I show here the calculation that we use to generate a return expectation for the S&P 500. Essentially, we separate the components of return into two different pieces. On the left, valuation pieces, so price to earnings and profitability, both of which are volatile and you can model via mean reversion. And on the right, the fundamental pieces that flow through from the underlying evolution of profitability and valuation. And so it would be possible for us to construct an attribution exquisitely tailored to look at whether the forecasts inherent in our own investment process are coming to fruition. And again, finding a way of framing the short term in the long term. Okay, so before I conclude, I one point that I'd like to make here is I've directed the spotlight here in thinking about investment performance on the investment manager. But this is rather sweeping under the carpet one of the biggest problems with the investment management industry, which is that there were two parties there was a party on either side of that contract that we started with. The investing institution is often as much of the problem in long-termism in portfolio management. Quite often the investment manager does attempt to see out the plan over the long term, only to have the rug pulled from under them by clients who are unwilling to go the distance. So, to conclude, the short term is your problem, even if you're trying to invest for the long term, because inevitably that's what we have to react to. I've proposed a few different tools to try to twist the prism a little bit so that we can think about the short term from a slightly different perspective. But unfortunately, in the end, there's no alternative to the hard work of really getting to know what your managers are doing and trying to understand how they're managing your portfolio. Sorry. Okay, thank you.